Let's talk about 5 baseline calculations to use when analyzing a potential investment property. There's cash flow, net operating income, return on investment, cap rate, and cash on cash return. Let's start with cash flow. The cash flow of a property tells us the monthly or annual profit from the property. A negative or break-even cash flow indicates an investor should walk away. To calculate cash flow, we need to know the monthly income and monthly expenses. Here's a list of what common monthly expenses may include. Monthly income will include your base rent and may include laundry, storage, or vending. If there are no tenants in the property you're interested in, you can evaluate the rental income of nearby properties by consulting a real estate broker in the area. Then you take your monthly income, subtract your monthly expenses, and you have your cash flow. Next up is net operating income, or NOI. The NOI helps an investor get an idea of potential profitability and financial health of an investment property in relation to how much it costs to operate it. The NOI is generally calculated on an annual basis. So if you know what your monthly income and expenses are, just multiply them by 12 to get your yearly totals. The NOI equals your gross income minus your operating expenses. Gross income includes rental income and any other income you may be collecting on your property, including parking, vending machines, or laundry. Operating expenses include vacancies, property taxes, insurance, repairs and maintenance, and property management fees. Keep in mind the NOI does not include acquisition costs such as mortgage payments and interest. This is what makes the NOI different from a property's cash flow. Essentially, NOI is the net cash you earn before paying mortgage payments and income taxes. Let's look at an example. Rental property number 1 has a rental income of $50,000 and operating expenses that add up to $5,000. Property number 2 has a rental income of $100,000 and operating expenses that add up to $65,000. Plugging these numbers into our formula, we see that rental property number 1 has an NOI of $45,000, while rental property number 2 has an NOI of $35,000. As you can see, while the second investment property generates more rental income during the year, it also has more operating expenses than the first. Now let's look at return on investment. The ROI gives the annual return on the investment by taking in all factors that affect the bottom line. We know our monthly cash flow is monthly income minus monthly expenses. Next, we add the principal payment, which is the monthly payment you make towards the equity of the property. Take your cash flow and your principal payment and multiply it by 12 for your annual return. We consider it a return because it's cash in your pockets and one payment closer to paying off the debt. Now divide that by your total investment costs. Cash if you paid cash for the property, or down payment plus repairs, closing costs, etc. Your annual return divided by your investment cost is your return on investment. Now let's look at capitalization, or cap rate. This number tells the returns of the property independent of the financing. Generally, cap rates are used for analyzing commercial properties. The cap rate is calculated by dividing the net operating income by the property price. Let's go back to our rental property examples. Rental property number 1 had an NOI of $45,000, and rental property number 2 had an NOI of $35,000. Let's say you purchased property number 1 for $550,000 or number 2 for $1 million. Plugging those numbers into our formula, you can see the cap rate for property number 1 is 8.2% and the cap rate for property number 2 is 3.5%. Finally, let's look at cash on cash return. This formula calculates the cash income earned on the cash invested in the property. It takes the annual cash flow, the NOI, and divides it by the cash initially invested. Let's look at our examples one more time. Let's say our investor put down 35% on both properties, so $192,500 on number 1 and $350,000 on number 2. Plugging those numbers into the equation, we see that property number 1 had a cash on cash return of 24%, and property number 2 had a cash on cash return of 10%. It's important to remember that these calculations work together when analyzing a potential property, and there are also several other factors to take into account, such as the current market, area, and your financing options. If you'd like to learn more about analyzing rental properties, or you'd like to analyze a property together, feel free to shoot us an email at brandon@blackwellre.com.